The illusion of wealth. As 2025 draws to a close, Wall Street looks calm on the surface. Stock tickers flash green numbers, billionaire portfolios swell, and news outlets parade headlines of record-breaking gains. On paper, the economy seems resilient, even thriving. But beneath this glossy facade lies a fragile, dangerous reality. The so-called gains are largely imaginary. Artificial inflation of stock prices, speculative bubbles, and leveraged investments have created an illusion of wealth that could collapse at any moment. Investors, driven by fear of missing out, continue to pour money into markets without understanding that much of the value is detached from real economic fundamentals. The Federal Reserve US interventions over the past decade have played a critical role in sustaining this illusion. With low interest rates and repeated quantitative easing programs, liquidity flooded the financial system. Banks and investment firms used this capital to drive asset prices higher, but this growth was largely unearned. It was a product of policy, not productivity. Companies that should have faltered under normal market conditions were propped up by cheap money, and stock prices soared well above intrinsic values. Meanwhile, the average American, seeing headlines of booming markets, is convinced that wealth is spreading across the nation. But this perception is dangerously misleading. Corporate earnings reports have become exercises in creative accounting rather than honest reflections of financial health. Firms report profits that mask rising debt levels, underfunded pension plans, and unsustainable operational costs. Wall Street analysts, pressured to maintain bullish narratives, often gloss over warning signs. Meanwhile, derivative markets have grown exponentially, with trillions of dollars tied up in bets that rely more on speculation than actual performance. The sheer complexity of these financial instruments means that when the bubble bursts, the average investor will have no idea how or why they've lost everything. Technology companies, once hailed as the saviors of the modern economy, are at the heart of this fragile ecosystem. Many of the largest firms trade at price-to-earnings ratios that defy logic, relying on anticipated future growth that may never materialize. Investors continue to chase these stocks, fearing that missing out now could mean missing generational wealth. But in reality, these valuations are not sustainable. The moment confidence wavers, triggered perhaps by a single missed earnings report or regulatory shock, the bubble could burst, dragging the broader market down with it. Housing markets, often considered separate from Wall Street, are intertwined more than ever. Mortgage-backed securities, derivatives tied to property, and leveraged real estate funds have tied millions of Americans' fortunes to Wall Street as precarious balance. Any significant market correction would ripple through housing prices, eroding home equity, destabilizing local economies, and causing widespread financial panic. The interconnectedness of these sectors amplifies risk. What may start as a Wall Street stumble can quickly become a nationwide economic crisis. The global stage adds another layer of vulnerability. Emerging markets that borrowed heavily in dollars now face skyrocketing debt costs as interest rates rise. Nations dependent on exports to the US, and Europe may find themselves unable to service their debts, triggering defaults that could reverberate worldwide. This interconnected global economy means that the collapse of what appears to be a localized Wall Street bubble could ignite a chain reaction, affecting millions of lives in far-flung corners of the globe. Every crisis in history shares a common pattern: a period of irrational exuberance, widespread denial, and overconfidence. Right now, that pattern is unmistakably present in the 2025 market. Investors ignore mounting risks, believing that authorities will always intervene to save the system. Yet, intervention has limits. The Federal Reserve and other central banks may have patched the system temporarily in the past, but they cannot create real wealth or prevent the correction of overvalued assets indefinitely. The longer this illusion persists, the harsher the eventual crash will be. Financial experts who warn of impending disaster are often dismissed as pessimists or alarmists. Yet their predictions are rooted in decades of studying market cycles, debt accumulation, and human behavior. The history of financial crashes from 1929 to 2008 teaches one critical lesson: when markets become divorced from reality, collapse is inevitable. What is unique about 2025 is the scale and speed at which artificial gains have accumulated. Technology, high-frequency trading, and globalized finance have created a system that is more interconnected and therefore more vulnerable than ever before. The consequences of ignoring this risk are staggering. A market crash in 2026 would not merely affect stock prices. It would destabilize pensions, retirement accounts, municipal budgets, and corporate balance sheets. Consumer confidence would plummet. Businesses would freeze investments, and unemployment could spike dramatically. The illusion of prosperity, built over years, would vanish almost overnight. Those who believe themselves secure, often the very people flaunting wealth today, would find themselves exposed to the harshest realities of economic collapse. In conclusion, the gains of 2025 are not what they appear. They are a fragile mirage, held together by speculation, government intervention, and human optimism. While headlines trumpet unprecedented wealth, the foundation of these gains is weak, unstable, and increasingly dangerous. As 2026 approaches, Wall Street stands on the brink of a collapse that could destroy not only financial institutions, but also the livelihoods of millions who mistakenly trusted in paper wealth. The illusion is ending, and when it does, the consequences will be felt everywhere, from boardrooms in Manhattan to living rooms across suburban America. The domino effect on the economy. As the cracks in Wall Street's facade widen, the implications for the broader economy are becoming impossible to ignore. The fake gains of 2025 are not confined to hedge funds, billionaire portfolios, or stock indices. They seep into every corner of the financial ecosystem. Corporations, banks, and everyday Americans are all interconnected in ways that make a market correction devastatingly contagious. The illusion of stability has lulled governments and investors alike into a false sense of security, while the reality is a tightly wound system poised to unravel. The domino effect, once triggered, will move faster than most anticipate. Consumer behavior is one of the first casualties of this fragile financial landscape. For years, Americans have been encouraged to spend as if prosperity is permanent, fueled by rising asset prices, low interest credit, and seemingly endless wealth accumulation. Credit card balances, auto loans, and mortgages have all climbed to historic levels, underpinned by confidence in Wall Street's apparent invincibility. But this confidence is brittle. As soon as a major index begins to decline, panic spreads. Spending slows, businesses experience reduced revenue, and the economy enters a self-reinforcing cycle of contraction. What was once perceived as wealth evaporates almost overnight, and households quickly find themselves struggling to maintain lifestyles predicated on borrowed prosperity. Corporate America is equally exposed. Many firms have relied heavily on stock buybacks and speculative investments rather than real growth and productivity improvements. These strategies worked only as long as investors continued to pour money into overvalued shares. Once the market sentiment shifts, these companies face the harsh reality of declining stock prices, rising debt costs, and eroded consumer demand. Even companies with solid fundamentals are not immune. Their valuations are inflated by association with the broader market. The moment panic sets in, the financial dominoes begin to fall, and layoffs, bankruptcies, and credit freezes become inevitable. Small and medium-sized enterprises, SMEs, are particularly vulnerable. Unlike large corporations, they lack access to cheap capital and are more dependent on day-to-day cash flow. As large financial institutions falter, banks tighten lending standards, leaving SMEs without the credit needed to operate. Many will be forced to shut down, causing local unemployment spikes and deepening regional economic crises. Communities that once thrived on these businesses will experience cascading consequences: reduced tax revenue, declining property values, and social instability. The ripple effects of Wall Street's failure extend far beyond New York, Gas Financial District. They strike at the heart of everyday life across the nation. The housing market, often touted as a separate sector, will amplify the crisis. With mortgage-backed securities tied directly to Wall Street valuations, a decline in stock prices triggers a feedback loop that undermines housing stability. Homeowners who purchase properties based on inflated home values may find themselves underwater, owing more than their homes are worth. This scenario mirrors the 2008 financial crisis, but with even greater intensity, given the current levels of household debt and global market interconnectivity. Foreclosures surge, communities destabilize, and banks, already reeling from stock market losses, face simultaneous pressure from mortgage defaults. Financial instruments once considered sophisticated have become ticking time bombs. Derivatives, options, and other high-risk vehicles have expanded exponentially in the last decade, often outpacing the ability of regulators to monitor them effectively. Many of these products are based on assumptions of continuous market growth. In such a tightly interwoven market, no player is truly insulated. The domino effect of failing investments spreads from one sector to another, igniting a chain reaction that policymakers may struggle to contain. The labor market is another crucial area where the effects of a collapse will be acutely felt. Unemployment often lags behind financial market declines, but when it strikes hard. As companies face declining revenue and credit freezes, layoffs become inevitable. A surge in unemployment reduces consumer spending, further depressing business revenue and prolonging the downturn. Millions of workers may suddenly find themselves without income or prospects, triggering a social and political crisis on top of an economic one. The stress on social welfare systems, unemployment benefits, and public services could be unprecedented, exacerbating public discontent and shaking confidence in institutions. Global trade and international finance are inseparable from Wall Street's fortunes. Countries that rely on U.S. imports or investment capital are at risk of financial contagion. Emerging markets, already burdened with high debt levels, may experience defaults that destabilize regional economies. Major banks with international exposure will face losses not only domestically but abroad, spreading panic to financial centers in Europe, Asia, and beyond. The interconnectedness of the modern economy ensures that a Wall Street crash is not a local problem. It is a global crisis in waiting. Markets in Tokyo, London, and Frankfurt will feel the tremors almost simultaneously, creating a worldwide atmosphere of uncertainty and fear. Policymakers are aware of these risks, but face limited options. Interest rate adjustments, quantitative easing, and emergency lending programs have diminishing returns. Governments cannot create real wealth out of thin air, nor can they indefinitely prevent markets from correcting inflated valuations. The longer they delay decisive action, the more severe the eventual collapse will be. Furthermore, political polarization hampers swift and coordinated responses, meaning that public trust in institutions will erode just as the crisis intensifies. The result is a perfect storm. An economy built on illusion, a population lulled into complacency, and policymakers constrained by both politics and practicality. Psychology plays a crucial role in the unfolding disaster. Human behavior underpins financial markets, and collective panic can be as destructive as any technical failure. When investors recognize that the gains of 2025 were largely fabricated, fear spreads rapidly. Margin calls, forced asset sales, and abrupt withdrawal of funds create liquidity crises that compound the initial collapse. What begins as a technical correction can quickly spiral into a full-blown financial panic, with consequences far exceeding the initial shock. Behavioral economics teaches that markets are rarely rational. In moments of crisis, emotion often outweighs logic, accelerating downward spirals beyond what historical models predict. In sum, the fake gains of Wall Street in 2025 are not just a warning, they are the prelude to a systemic collapse. The domino effect will touch every sector of the economy: households, corporations, banks, small businesses, international markets, and labor markets alike. The illusion of prosperity is crumbling, and when it falls, the damage will be comprehensive and long-lasting. While some may still cling to hope or believe in miraculous interventions, the signs are unmistakable. The economic foundation is weak, over-leveraged, and dangerously unstable. 2026 promises to be a year when the consequences of illusion meet the harsh reality of financial collapse, leaving no sector untouched and no individual unaffected. The political and social fallout. As the financial dominoes continue to tumble, the effects of Wall Street's 2025 illusion are no longer confined to banks and markets. They spill over into the political and social fabric of the nation. Economic crises are rarely just about money. They reshape societies, influence elections, and redefine the relationship between governments and citizens. In 2026, the collapse of fake gains threatens to create political upheaval, the likes of which America has not seen in decades, while social unrest may grow as people confront the stark reality of widespread financial instability. Politicians, both local and national, will face immediate pressure to respond. Historically, leaders have often been judged less by long-term policy and more by their ability to manage crises. As households lose wealth, businesses close, and unemployment spikes, citizens will demand swift action. However, solutions will be limited. Fiscal stimulus packages, emergency loans, or interest rate adjustments may provide temporary relief, but they cannot reverse the underlying structural weaknesses exposed by the crash. The inevitable frustration of the public may fuel populist movements, challenging the political establishment and threatening the stability of governing institutions. Public trust, already fragile in an era of hyper-partisan politics, will be tested like never before. For years, financial institutions were portrayed as pillars of stability, yet their failures will reveal a system riddled with risk and speculation. Citizens who believed in the security of retirement accounts, pensions, or housing investments may feel betrayed, fueling anger and resentment. Social media platforms will amplify these sentiments, spreading outrage quickly and sometimes irrationally. Protests, strikes, and civil unrest could erupt in urban centers as the economic shockwave hits hardest, where inequality and financial vulnerability are most pronounced. Income inequality, already a critical issue, will worsen dramatically. The 2025 market gains disproportionately enriched the wealthiest Americans, many of whom are now insulated from the worst effects of a collapse. Meanwhile, middle-class families and lower-income households, those who stretched credit, invested retirement funds, or relied on housing equity, will bear the brunt of financial devastation. This widening wealth gap can create social tensions, fueling resentment toward both the elite and the government that appears unable or unwilling to intervene effectively. Political discourse may radicalize, triggering defaults that can destabilize foreign economies. Trade relationships will strain under these pressures, particularly in regions heavily reliant on U.S. investment or aid. The 2026 crash has the potential to ripple far beyond domestic borders, destabilizing alliances, trade agreements, and even global security structures. Social services and public institutions will be forced to absorb much of the shock. Unemployment insurance, welfare programs, and healthcare systems will come under unprecedented strain as millions of citizens lose income or face financial insecurity. Education in the younger generation will not be spared from the fallout. Families facing economic uncertainty often reduce spending on higher education, extracurricular programs, and enrichment opportunities. The financial stress on households may force young adults to postpone college, take on unsustainable debt, or enter the workforce prematurely. Over time, this disruption in education can have long-lasting effects on productivity, innovation, and societal mobility, leaving a generation at a disadvantage in both domestic and global economic competition. The media will play a central role in shaping public perception of the crisis. As the reality of the 2025 bubble's collapse becomes undeniable, coverage will likely oscillate between panic-inducing headlines and attempts to offer reassurance. Sensationalized reporting can exacerbate fear, prompting more aggressive market reactions and further destabilizing the system. On the other hand, some outlets may underplay the severity of the situation, creating confusion and mistrust. Citizens, unsure whom to believe, may react impulsively, selling assets, hoarding cash, or protesting policy decisions, all of which intensify the downward spiral. Psychological impacts on society are equally important to consider. Economic collapse can trigger widespread anxiety, depression, and social tension. Families stressed by financial insecurity may experience higher rates of domestic conflict, health issues, and strained relationships. Communities may fracture under the weight of uncertainty, eroding social cohesion and trust. In extreme scenarios, prolonged economic instability can give rise to radical ideologies, as people seek solutions outside traditional democratic frameworks. The psychological toll of financial collapse is profound and often long-lasting, influencing behavior and societal norms for decades. Corporations, governments, and households all share one common vulnerability: reliance on confidence. Markets are not solely numerical. They exist because people trust in the system. When confidence collapses, so does liquidity, consumption, and investment. This feedback loop accelerates the crisis. Even policies designed to stabilize markets may fail if public sentiment is too negative. Fear of further losses can drive investors to liquidate positions en masse, intensifying market volatility and creating a cascade effect that few institutions are prepared to manage. In essence, the crash of 2026 will be more than a financial event. It will be a societal reckoning. The illusion of wealth from 2025 exposes not just market vulnerabilities, but the fragility of trust, political stability, and social cohesion. While some sectors and individuals may survive relatively unscathed, the majority of the population will feel the consequences in every facet of life. From job security to housing, from education to healthcare, the repercussions will ripple across society, leaving few untouched. As Part 3 concludes, the picture is clear. The 2025 Wall Street gains were not merely artificial. They were a ticking time bomb. The economic collapse is intertwined with political uncertainty, social tension, and global instability. Recovery will not be swift, and the scars of this period may shape governance, policy, and societal behavior for years to come. Americans, and indeed the global community, are facing a moment of truth. The price of illusion is about to be paid in full. The collapse and path forward. As 2026 unfolds, the financial illusion of 2025 finally shatters. Stock markets plunge, derivatives implode, and the so-called gains of the previous year vanish almost overnight. The domino effect we predicted in earlier parts reaches its peak. Corporate bankruptcies surge, banks face unprecedented liquidity crises, and millions of Americans find their savings, pensions, and investments severely depleted. The illusion of endless prosperity gives way to the harsh reality. Markets built on speculation, debt, and overconfidence cannot withstand the weight of truth. Financial institutions, long assumed to be too big to fail, scramble to contain the chaos. Emergency measures, such as central bank liquidity injections and temporary trading halts, provide only fleeting relief. Confidence, the very backbone of the financial system, has eroded beyond repair. Investors, from hedge funds to ordinary retirees, rush to liquidate assets, creating a vicious cycle of selling pressure. The velocity of the collapse surprises even the most seasoned analysts, proving that the interconnected global financial system is far more fragile than anyone admitted. Unemployment spikes dramatically as businesses, both large and small, are forced to cut costs or close entirely. Millions of workers, previously secure in their jobs, suddenly face uncertain futures. Communities that relied on local employment see cascading effects. Retail sales decline, municipal budgets shrink, and essential services struggle to operate. The social impact is profound. Families face eviction, students abandon higher education plans, and local economies spiral into contraction. The human cost of Wall Street's artificial gains becomes painfully visible, far beyond mere numbers on a balance sheet. The housing market, long considered a separate pillar of the economy, crumbles under the weight of mortgage defaults and declining property values. Homeowners who once believed their equity would protect them find themselves underwater. Foreclosures rise sharply, further depressing local real estate markets. The 2008 housing crisis is dwarfed in comparison, as nearly every sector of the economy is simultaneously affected. Financial stress permeates households, leading to heightened anxiety, strained family relationships, and social unrest in some urban areas. Internationally, the collapse sends shockwaves through global markets. And nations with heavy exposure to U.S. financial products struggle to stabilize their economies. Emerging markets reliant on dollar-denominated loans default, creating regional instability. Trade flows shrink as uncertainty grows, and geopolitical tensions intensify. Global supply chains, already fragile, face disruption. Countries that once depended on steady investment from the U.S. now confront a harsh reality. Economic interdependence means that Wall Street MS collapse is a worldwide event. Politically, governments scramble to respond. Policymakers introduce emergency stimulus packages, negotiate debt relief for affected nations, and attempt to stabilize domestic financial systems. Yet, the speed and severity of the collapse limit the effectiveness of these measures. Public trust, already fragile, erodes further. Protests, strikes, and populist movements gain momentum as citizens demand accountability. Political polarization intensifies, making coordinated solutions even more difficult. The crisis underscores one undeniable truth. Financial systems do not exist in isolation. They are embedded within the social and political fabric. And when they fail, everyone feels the consequences. Amid the chaos, lessons emerge. Economists, policymakers, and investors are forced to confront the dangers of speculation, debt accumulation, and over-reliance on artificial market stimuli. Transparency and regulation, long ignored in pursuit of rapid profits, become urgent priorities. There is a renewed focus on building resilient systems, diversified investments, sustainable corporate practices, and robust social safety nets. While recovery will be slow, the collapse offers an opportunity to rebuild financial and societal structures in a more stable, equitable manner. The psychological impact of the collapse cannot be understated. Individuals who once felt secure in the illusion of wealth face emotional and mental stress, grappling with lost savings, job insecurity, and uncertainty about the future. Communities must come together to support each other, fostering resilience in the face of adversity. Education on financial literacy becomes critical, as the public seeks to understand not only what went wrong, but how to protect themselves from similar shocks in the future. The human cost reinforces the necessity of long-term planning and caution in financial decision-making. Looking forward, the path to recovery will be gradual and uneven. Markets may regain stability, but the lessons of 2025, 2026 will remain etched in the collective memory of investors, policymakers, and citizens alike. Confidence, once shattered, takes years to rebuild. The collapse exposes the vulnerabilities of over-leveraged systems, the dangers of speculative bubbles, and the consequences of prioritizing short-term gains over sustainable growth. For individuals, businesses, and nations, the challenge is clear. Adapt to reality, reduce reliance on artificial market mechanisms, and embrace a cautious, informed approach to financial decisions. In conclusion, the 2025 Wall Street gains were a mirage, a dangerous illusion that masked systemic weaknesses. The 2026 collapse demonstrates the interconnectedness of markets, households, businesses, and governments, revealing that no sector operates in isolation. The domino effect has struck with force, reshaping economic, social, and political landscapes. Yet, amidst the turmoil lies an opportunity to learn, adapt, and build systems resilient enough to withstand future shocks. Financial literacy, regulation, and prudent investment practices will be essential in ensuring that history does not repeat itself. If you found this breakdown insightful and want to stay informed about the hidden truths behind financial systems, make sure to like this video and subscribe to our channel. By joining our community, you'll get updates on the latest economic analysis, market predictions, and deep dives into how global events impact your personal finances. Don T, so didn't forget to click the notification bell so you never miss a video that could help you navigate these turbulent times. The story of Wall Street's illusion and inevitable collapse is a warning for all, but it's also a guide for those willing to learn. Arm yourself with knowledge, question what seems stable, and always prepare for the unexpected. The financial world may be unpredictable, but understanding its mechanics gives you the power to survive and even thrive when others are caught off guard. This is the hidden history of the 2025 crash, and the lessons it leaves behind will resonate for years to come.